Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly edition of the economic review for the week ending not October, I always say October these days. I'm feeling like fall is upon us. It's August 25, 2023. So let's start with a look at this week's markets. It'll close on Thursday. Positive for bonds. This week, the recent move in interest rates higher was pretty detrimental to the performance of bonds over the last few months. But now it seems to be exhausted. This move, we'll see if it is the case, but it's starting to look like this. And we've seen some European data and some US data coming out. It was a bit on the weaker side, and this was enough to push interest rates lower this week, thus some gains. So back positive territory year to date for the universe index, but it's a fragile equilibrium, I would say. For equities, TSX was slightly negative, positive elsewhere. We did see some positive rebound from technology in the Nasdaq at the beginning of the week, but later in the week we did have the Nvidia earnings report, which was exactly what investors would want to see. Strong growth in revenue, strong guidance, but still the market was down based on that, and especially technology was down. So it seems that we're in the profit-taking part of this cycle there, and this is common. When you have such strong moves on exuberance on a theme, at some point this exhausts itself and you have some profit taking, and it seems that we are in this phase. So let's see if that's the case, but it does seem like that. IFI and emerging positive on the week. Oil down below $80 this week. Canadian dollar, euro down. Price of gold higher. So it was a bit quiet on the macro front, so I thought maybe I'd focus more on the markets this week. Maybe starting with this chart here. The recent outperformance of the tech sector is historical. And this chart here, this is the rolling outperformance of the S&P 500 versus the equal weight version. So in the equal weight version, you take exactly the same stocks as in the S&P 500, but every stock has the same weight. So Apple, which is the biggest company in the world, has the same weight as the smallest stock in the S&P 500. And what you can see here is that the outperformance of tech pushed the performance. This is a rolling 6-month window, so going back almost the beginning of this year. The outperformance was of the index versus the equal weight was the largest since coming out of the COVID bear market. That was a flash bear market, and pretty much in line with what we saw in the late 1990s when we had the dot-com bubble. So it was historical how one sector, namely tech, was led to an outperformance of the index versus its equal weight version. So there was little breadth, it was mostly about tech. So that brings us to the next chart here. This is opening a convergence trade between tech and energy. And why energy? Well, tech is the poster child for growth, and energy is the poster child for value. So typically these sectors tend to be played one versus the other. There are other ways to play a convergence trade. If you think that tech outperformed, then maybe there's going to be a convergence towards, or let's say a rotation towards cyclicals and value, but energy seems always to be a good candidate. So the outperformance of energy, technology on the left versus the index was, as I said, historical, and at the same time, of course, energy underperformed the index. So if you want to play a convergence trade, well, these two being long energy and short technology is a good way to do this. So these are the kind of, just to illustrate the kind of trades that we're putting in the portfolios right now. This is more of an alpha trade, so you want to add performance to the portfolio, but without taking more exposure to equities or to fixed income, so keeping the beta pretty much stable. Here you have this convergence trade, or this relative trade, that is a good opportunity. So this is something that we put together in the funds recently. Next here, maybe the interest rates, they've continued to move higher recently. We put the 20 plus year chart here for US 10-year rates. You can see since the lows of 2020, 2021, there's been ample movement already. But just recently, if you look at the far right side of this chart, you see that the last few months also have been pretty busy in terms of interest rates rising for the 10-year in the US. And this is fueled by two things on the other chart here: the real rate component and the market inflation expectations. So you can decompose any 10-year rate by the real component and the inflation expectation part, measured by the break-evens. So the 10-year rate is about growth expectations. So the soft landing or no landing narrative has been taking have been making ground recently. We still are doubtful, but markets are pricing that in, and also the expectations for monetary policy to stay stricter for a good while, that also push the real rates higher. And on the right, you see that the market inflation expectations have been rebounding somewhat recently. So both factors have been pushing interest rates higher. And this is very important because when you're thinking about asset allocation or building a portfolio, you need to think about all of the pieces together. Okay, it's a relative game. So if you go more towards equities, that means that you need to underweight fixed income or underweight other asset classes. And now that interest rates are this high, that means that the prospects for return over the long run on the fixed income side are much higher, because you can lock in higher yields by building a portfolio at higher rates like you have right now. And also this creates a very interesting alternative to holding equities. And remember that let's say 10-12 years ago, interest rates were so low that a term was coined of TINA, there is no alternative. And this is in this chart here, which will be the final one. TINA was there is no alternative, because interest rates were so low that you wanted to hold, well, US equities, where you had the biggest companies in the world. You could get a dividend, you could get earnings growth, you could get multiples expansion, you could have all of that. And if you held fixed income, where you were kind of stuck with very low rates. Now that rates are elevated, it plays a factor into how you build a portfolio. You want to have it more diversified, you want to have more fixed income in your portfolio now, but also if you look at the long-term prospects of equities, you need to review them downwards, because there's a strong alternative now to just holding equities. And this is what we catch by the concept here of equity risk premium. On the left, it is the equity risk premium versus the 10-year rate in the US. So you just take what we call the earnings yield. So earnings expected over the next 12 months divided by the price of the index. So pretty much the inverse of the PE ratio minus the 10-year rate. You get the chart on the left. And when the line is lower, that means that equities are more expensive versus bonds. So on the left, you see that according to the 10-year version of the equity risk premium, at the 10-year rate version, the equity risk premium is as low as it was pre-financial crisis. So it's been about 15 years since equities have been this expensive compared to 10-year bonds. This is the signal here. But much more interestingly and much more importantly on the right, if you do the same concept but with the 3-month rate, so that's pretty much the money market. So you can have 5% plus return when you invest in the money market in the US. Well, the valuation of equities versus that is the most expensive now since the dot-com bubble. So what you're paying versus what you're getting in terms of earnings on the S&P 500 is very expensive compared to a very safe alternative of just parking your money in 3-month bonds and getting that yield. So that's a very important shift. So this is why we say, well, is it from TNUT to the term that we just made up, TAPA? So there are plenty of alternatives. If that is the case, and if it stays like that for a while, and we expect that it will, that means that the prospects for an outperformance of equity are being dimmer, and the interest for equity should be lower now, given the more attractive rates that you can get elsewhere. So asset allocation is a relative game, and here you always need to look at the valuations of equities versus fixed income to really have a feel of, price is what you pay and value is what you get. All right, so in Canada, next week we'll have Q2 GDP growth. Should be a bit lower at 1% positive, 1%, but still lower from Q1 where we had 3% plus growth. S&P Global Manufacturing PMI also will be out. In the US, we'll have the Conference Board Consumer Confidence Index. Core PC inflation, which is the measure followed by the Fed, should be rebounding there also in July to 3.3% year over year. The non-farm payrolls should be lower at a positive 168,000 in August, and the ISM manufacturing index going pretty much sideways but in contraction territory at 46.9. So that wraps it up for the week. ia.ca/economy. You can find the podcast. You can find this review here. iagam.ca/insights. You can have the monthly macro and strategy that we produce in our team, and also the weekly note that will just summarize a few things that happened during the week to complement this video here. So thanks for following us, and I'll be back again next week.